Hi, and welcome to my channel. For those of you new, my name is Dave and I work in financial services. And these videos are a mixture and journey towards financial freedom, financial products, financial well-being, so you, like me, can reach your goals sometime in the future. Now let's get into the latest video. Now this latest video is about my self-invested personal pension plan for the month of September 2023. Now I do have a workplace pension with my current employer, but I'm restricted on one, the amount of contributions I can pay in through auto enrolment, and two, the number of funds or the investment opportunities is a very few selected funds. So I do my own self-invested pension plan, so I can pick my own funds, my level of investments based upon my attitude to risk. The aim of the portfolio is an annual return of 10% each year. So we'll have good years and bad years, but an average of 10%. For 2023, we're looking at annual dividends of £4,500 and a year-end valuation of £117,000. So how have we done during the month? Well, year to date, we're up 6.89%. Not around 10%, but compared to the FTSE 100, which is down 1.1%. If you look at the following chart, sort of valuation we had during the month. So the start of the month, the portfolio was worth £101,201. End of September, it was worth £103,166, increase during the month of £1,965. Now, normal contributions went in of £200 a month, of which the government added tax relief of £50, which is 25% as a basic rate taxpayer, and our platform provider charges monthly fees of £14.88, which is valuation of our total portfolio holding, roughly about the same each month. If you look at the following chart, sort of regions or graphics of where we hold the fund. So predominantly UK and Europe based, 82.63% in that section, 14.95% in America, and 2.42% in Asia and emerging markets. Now during the month we received our second best month of dividends for the year. Again, look at the following chart, we received dividends of £714.96, so a nice month. Across our holdings, our yield is giving us of 4.32%, and the year-to-date dividends of £3,476.68, which is about £101 above our expectations, but a very good month. So where did we receive dividends during September? Penn and the Water Group gave us £39.59, we've kept as cash. Lloyds the Banking Group, £316.72, which gives us 735 new shares. Barclays the Bank, £82.02, gave us 50 new shares. Shell gave a quarterly dividend of £39.18, we'll keep as cash and reinvest. BP gave us £31.06, we'll keep as cash and reinvest. HSBC gave us £89.51, 13 new shares, and back on quarterly dividends. And finally, Legal & General, £116.88, gave us 51 new shares. So a nice month, £715 dividends, completely tax-free within the portfolio. Now the aim of these videos is not to get rich quick scheme, it's to prove I can build a sizable portfolio, so can you. So remember, if you like the videos, smash the like button, subscribe to this channel, but these are my own personal opinions. So let's dive into the portfolio and see what sort of holdings we have in the shares or the funds. So firstly, the shares. We own 15 shares, 9 in profit, 6 in loss. Total value of £79,843, of which 69% is in the FTSE, 8% is in the FTSE 250. And let's see what sort of holding we hold. So our largest holding is Aviva, 4,533 shares, £17,500, 7%, will give a very nice dividend at the start of October. Safe, secure, cash rich, but giving a yield of about 8%. Our next holding is Lloyds Banking Group. We did increase in the month for the holdings, 36,162 shares, £15,500, 15% of our portfolio. HSBC, 1,135 shares, £7,300, 7% of our portfolio, but it was done for diversification is very cash rich, is giving a quarterly dividend, and it will give a special dividend at the start of 2024. Away from the banks, we own Greggs, the bakers, 282 shares, will give it a dividend at the start of October. £6,900, has struggled lately, but some very good results, very good trading stations, very cash rich, and it is still opening around about 150 new shares each year. But it makes up 6.7% of our portfolio, a very cash rich company. On to, shall we say, quite selective, it's Drax, the biomass pallet maker. 1,229 shares, £5,400, 5% yield. Has struggled during the month because of, shall we say, the restrictions on the moving forward, but very cash rich, will give a very nice dividend during the start of October. But for some reason, the share has prices regularly struggled this year, but originally we were up 100% within the holding. Back onto the banks, we own Barclays, 3,088 shares, £4,900, 4.8% of our portfolio. Legal and General, we own 2,098 shares, £4,500, 4% of our portfolio. Just like Aviva, very cash rich, very profitable, is giving a yield of around about 8%. And then some shares that have done good lately. We own Shell, £3,900, 3.8% of our portfolio, and BP, 542 shares, £2,900, 3% of our portfolio. Oil price is very high, shall we say, but it does pay a very good quarterly dividend as highlighted during the month. We also own JD Sports, 2,500 shares, £3,800, 3% of our portfolio. It's very cash rich, it's on a buying spree, and it is about to expand in more operations in Europe, but it's got over £1 billion cash. It can fund the purchase, shall we say, with cash outright. And then we own, shall we say, Sainsbury's, the retailer, 1,233 shares, £3,000, 3% of our portfolio, very cash rich, very good results recently, dividends increased, but shall we say, affected by a cost of living crisis. Other shares we own, shall we say, is Penn and the Water Company, has been affected by what's happened, shall we say, with the outcry of sewage and excessive charges, but it is cash rich, did pay a good dividend. We own AJ Bell, the platform provider, seen as a growth company, very good assets under management, so we say increasing customers, does pay a tiny dividend, but it is a growing company. We own AJ Bar, the drinks producer, did have very good results in the month, pre-tax profits up 12%, revenue up 33%, dividend increased from 2.5p to 2.65p, but again, very cash rich company. And we also own Card Factory, again, very cash rich. So we say, is on some kind of restriction because of the banking covenant it took out, but it is showing a nice profit. It is increasing stores. It is increasing a online presence because it's probably high street based. But it just goes to show a collection of companies, predominantly based in financial services and insurance, because it's what we know, shall we say, but all safety core companies being here for 100 years will be here, shall we say, next 50 to 100 years. Does what it says in the tin, and we just switch off, but we've got no reason to, so we say, to sell the shares. We are in fact increasing shares through the dividends as we've improved during the month. Let's look at what sort of funds we hold in the portfolio. Now, at the moment, we're on 5 funds. Makes up £23,000, 22% of our portfolio. It was done for diversification because we were solely, primarily share-based and UK-based. Now, during the month, we topped up our contributions, the Fidelity World Index at £250, so our contributions tax relief to increase one of our existing holdings, done for diversification. So where do we hold the funds? Our largest fund is a legal and general technology fund, £8,200, 7.9% of our portfolio, owns around 280 stocks, all kind of big players. Did struggle 2022, has a very good results overall in 2023, but it was done, so we say, to give a sector across the big players in the United States. We own the Fidelity World Index, £6,800, 6.63% of our portfolio, owns around 1,500 companies across the world, as the headline says, but very low fees of 0.1%. We just switch off, shall we say, covers diversification. Our next fund is quite selective, badly gifted positive change, £3,300, 3% of our portfolio. Has struggled lately, shall we say, is in profit, but it owns about 35 companies, quite selective, but it was done for a specific purpose. We own a Lindsell Train Equity Fund, £2,600, 2.5% of our portfolio. It was done, owns about 35 companies within the UK, shall we say, good old quality companies, shall we say, but it was done on the track record from the previous managers. And then our final fund that struggled lately is a Global Growth Fund. £2,300, makes up 2% of our portfolio. Our only holding in a loss, has struggled during the last 12 months, has recovered somewhat, but it's down, it's our only fund down to date. But as I've said, the funds were done for simplify, shall we say, to give us greater exposure because we were solely UK based. And as we've said, we're going to keep the funds moving forwards, but we are increasing the Fidelity World Index, shall we say, through monthly contributions and tax relief to increase the holding. We can just switch off, does what it says on the tin, no real investment risk. But it is giving annual return, shall we say, of around about 10% each year. And remember, these are my own personal opinions. It just goes to show if I can build a sizable portfolio, let's just say 6 figures, you can too. Through the power, shall we say, of regular investing, tax relief, reinvesting of dividends. Okay, so if I can do it, you can do it. And we'll see you again in the next video.